The information in this recording is general in nature and should not be considered personal advice. Please consult a professional and qualified financial advisor to discuss how this information may apply to your personal circumstances. Thanks for listening.
Hi everyone, Aadil Abbas from Own Financial Planning. In this video, we'll be discussing and learning more about enhanced strategic model portfolios by BlackRock. Before we go into the detail, a quick reminder that at Own Financial Planning, we have adopted a core satellite approach displayed in the center of the slide for portfolio construction. For our core component, which makes up the heart of the portfolio, we have chosen to partner with BlackRock. So to help us learn more, I'm today joined by Helmes, CFA charter holder and lead strategist for the Model Portfolio Solutions business in Australia, and a strategist in the Multi-Asset Strategies and Solutions group at BlackRock. So welcome, Uwe, and thank you for making the time to help us learn more about BlackRock's enhanced strategic model portfolios.
Hi, Aadil. Hi, all. Good to be here.
Welcome, Uwe, once again. So maybe we'll start, Uwe. Maybe my first question to you would be this. Firstly, can you tell us a bit about the history of BlackRock and your model and your model portfolios?
Yeah, absolutely. Well, BlackRock, we're the largest asset manager in the world, and we've served the Australian wealth market for over 30 years, with the aim to help more and more people plan for their financial future. So essentially, we partner with wealth organizations and financial advisors such as yourselves, Own Financial Planning, to ultimately help clients build better portfolios and bring thought leadership to the market, also help bring investment capabilities to the market with the ultimate goal to deliver better client outcomes. The enhanced strategic model portfolios that you've mentioned, they've been around for 10 years. So they've had a very good and strong track record. According to Morningstar, they've achieved first or second quartile performance over 1, 3, 5, and 7 years. So we're pretty happy to have delivered strong returns for our clients.
That's great to, that's really good to hear, Uwe, and it's good to hear about the history and the strong, I would say, performance you've had in the last 10 years. So thank you for sharing that. Maybe let's get into a bit more detail now. Maybe my next question to you is, can you talk a little bit more about your portfolio construction process and how it incorporates both a strategic asset allocation and a tactical asset allocation strategy?
Yeah, absolutely. And thanks for sharing this slide. So really, it boils down to four steps, and they're shown on this slide here. So we start off with sort of our long-term views across asset classes. So this is really important because it essentially forms the backbone of any multi-asset portfolio. So think, where do you want to be positioned over the long run? So most investors have a five-year investment horizon or longer. And so it doesn't really matter what happens on a day-to-day basis. You want to sort of have a long-term view. And so in step one, we essentially determine the strategic asset allocation for these portfolios. And then step two is we have a tactical asset allocation process in place. And yeah, thanks. So this goes into more detail. So here we understand that markets can move quite quickly. And while it is important to sort of have your long-term strategic views in place, we think it makes sense to dynamically or tactically tilt around those long-term views. So for example, if there's an unexpected market event, on the epidemic, then this particular process, so step two, helps us to tilt into and out of asset classes, countries, regions, so we can put on a so-called overweight to a particular asset class or underweight, and it just helps us to be very market aware and respond quickly to changing market conditions. And there's a rigorous process behind, so there's quantitative signals, qualitative assessments that goes into it, but it's a very rigorous process to determine how we want to be positioned on the short term. And then step three is to actually implement those various exposures. We use low-cost targeted ETFs to gain the desired exposures. And there's reasons for that. So they're typically pretty low cost. They're very efficient, and it helps us gain those exposures in a very cost-efficient manner. And then finally, step four, we want to monitor these and really sort of review these portfolios on an ongoing basis. So it becomes this iterative sort of cycle. These portfolios evolve over time. So they're not going to stay static. If market conditions change, if our long-term views change, these portfolios change as well. And so we monitor these portfolios on our own proprietary platform called Aladdin. So it's the platform we use for all of our portfolios, whether it's really large mandates, funds, or these model portfolios, they're all being tracked on Aladdin. And there's some really sophisticated tools that we can basically access here. So it all boils down to, we use Aladdin to really ensure that we know what's in these portfolios, we understand the risks, they're deliberate, they're diversified, and they're appropriately scaled.
That's really great to hear, Uwe, and I think thank you for just walking us through this process, which to me seems like a really thorough process where you look at the strategic asset allocation, try to like remove the noise which people experience on a daily basis, and then you have so many factors which you look at a tactical asset allocation level, and also then driven by low cost, because yes, as part of our investment philosophy at Own Financial Planning, we say to our clients, we aim to deliver model portfolios at the lowest cost sort of possible. So it's great to see your focus on low cost as well as you build the model portfolios, and then the review process through this, what seems like a wonderful technology or platform you have called Aladdin. I'm very intrigued by the name, but it's great to see that you have the review process as well. And as you said, it's an iterative cycle. So that gives a lot of confidence, I guess, to your clients around the fact that there is a constant monitoring happening and a review happening, because in terms of all the markets, they're quite dynamic. All markets are dynamic. And having a team over there which is looking at these things on a more regular basis gives us the confidence that the portfolios are adjusting to market conditions. Why do you use ETFs? And how does this portfolio differ from a pure index strategy?
Yeah, thanks, Aadil. Good question. So we use ETFs for their low cost nature. Typically, they're very efficient. We also the range of ETFs or exchange traded funds available in Australia has also gone up a lot in recent years, which for us is fantastic because it means we can now get all these exposures in a really targeted fashion. So if we want to get exposure to, let's say, Japanese equities, we can do that through an ETF. If we want to get exposure to US small caps, the pretty targeted exposure, we can actually get that exposure through an ETF vehicle or an exchange traded fund. So those are some benefits. They're typically highly liquid as well, and they're operationally quite efficient. So what that means is if we have a view across a particular sort of region or asset class, rather than having to buy hundreds of securities. So let's say if we want to go overweight, I'm making this up, US equities or Japanese equities, rather than having to buy hundreds of securities, which can be quite costly and operationally tricky, we can buy ETFs, which is essentially a basket of securities to gain that particular exposure. So again, it helps sort of create scale in the process and the proceeds down the feet. And then also you trade it daily, they trade it on the ASX. So again, there's a lot of transparency that comes with it. And we value transparency. We also know that our clients often value transparency. And then also something that's worth calling out is, so we use anywhere typically between 10 to 20 ETFs to build these portfolios. But if you actually look underneath the hood, so each of these ETFs is essentially a basket of securities. So while you might at any point in time see, let's say, 15 ETFs in the portfolio, if you actually look underneath the hood, clients get exposure to over 3,000 securities. So very, very diversified, highly diversified, and also it really lends itself nicely to being a core sort of strategy. So to your very first point, when you start this presentation, how you adopt the core satellite approach in your practice, these portfolios lend themselves really well to being that diversified, liquid, stable core.
Really interesting, Uwe, and again, it's very pleasing to see the thoroughness as to how you go around selecting the ETFs, similar to your thoroughness around the entire portfolio construction process, even at a micro level, which I would see this as a micro level at an ETF selection level. It's good to see all these factors. So Thank you for sharing this this ETF selection criteria as well. Then just Uwe, in terms of rounding out our conversation, maybe I would like to understand, how are your portfolios positioned today, and why do you have these positions today?
Yeah, absolutely. And this is a good slide to talk to. So the first thing to call out is there are guardrails in place. So we have 6 risk profiles. So when we build these portfolios, we build 6 different risk profiles, and then it's sort of up to you, or up to the advisor to essentially determine which risk profile is right for the ultimate client. But then looking at, let's say, our balanced portfolio. So this is our portfolio that typically has about half of the portfolio allocated to equities or to risk assets, and half the portfolio allocated to defensive assets. So within certain guardrails, it changes. So as you can see here, the portfolio evolves over time, allocations change over time. And so just to call out a few, so since late last year, we've had a bit more of a pro-risk stance in the portfolio. So essentially, last year, we felt that the market environment was actually fairly constructive, even though a lot of the opinions out there were actually quite negative. So a lot of people were calling for an imminent recession. There was a lot of negativity out there. We didn't see that. So we actually were a little bit more optimistic on the outlook. And so as a result, we had a bit more of an equity overweight in these portfolios without straying too far away from the long-term strategic holdings. And that's worked really well. So markets have actually performed really well since late last year, and we've been able to capture a lot of that upside as well. So today, we still have a risk-on stance in the portfolio. We've pared that back a little bit, so we're a bit more, a bit closer to our neutral holdings, but we still have an overweight to equities. In particular, we still have an overweight to U.S. equities. That's worked well so far this year. Also, another key change is we recently increased our exposure to emerging market equities. So we had an underweight to emerging market equities, and we've increased that exposure during our latest rebalance, as the market conditions, seem to be more favorable for that particular asset class. You can also see a couple of new colors on this slide. So earlier in the year, we added 3 new asset classes to the portfolio. So we added listed infrastructure, property, as well as gold. So they all have a place in these portfolios, and this speaks to the dynamic nature of these. So we consistently review these portfolios. We evolve the portfolios as market conditions change, and we want to make them better over time. So this is sort of something we think is a value add of these portfolios, that they actually they are being monitored, they do evolve. And that also is a reason why they're sort of different to sort of a very simple sort of index-only strategy that's sort of set and forget. We do recognize that markets change, and we think that it makes sense to update portfolios and make sure that they evolve in line with the market, and are hence market aware. And then on the fixed income side, just one more thing. So we have an exposure to inflation-linked bonds, which has been in the portfolio for a couple of years now, and that was sort of a result of the the inflation spike that we saw post-pandemic. And again, that exposure has also worked quite well. So we still hold Australian inflation-linked bonds in these portfolios, which is somewhat different to some of our peers. But again, we think it justifies an exposure there.
Wonderful, Uwe. I think this is a great example of the prior slides, which we spoke about the detail of your process and how dynamic it is. And I think what you've just spoken about is how dynamic you've been in managing these portfolios. And that allows you to be able to adjust portfolios to market conditions and be in the market, but still keep a focus on the long-term in terms of the long-term market cycles as well. So I think that's really good to see that all the principles you spoke about are actually, this is a good example of them being implemented. So that's wonderful. So thank you, Uwe, for your valuable insights. I hope our viewers were able to get a much better insight into the portfolio construction process for the enhanced strategic model portfolios, and why we've selected to partner with BlackRock as the enhanced strategic model portfolios being the core of our model portfolios. If you found this useful, please follow us on LinkedIn, Facebook, or YouTube, and get alerts when we release new content, similar new content. Feel free to email us if you wish to learn more about our asset allocation and portfolio construction advice services. And thank you for investing your time with us today. Thank you, Uwe.
Thanks, Aadil.